All right, welcome. Today, we're diving into something I think every investor is looking for, a way to build stable, reliable income. We're going to create a blueprint, step by step, using some of the biggest names on the NASDAQ to build a portfolio that's designed to pay you back. So let's jump right in.
I mean, this is the big question, right? We're so used to watching the markets go up and down, feeling great one day and anxious the next. But what if your portfolio could provide a steady stream of cash no matter what the market's doing? A way for your investments to directly reward you just for owning them.
And that's exactly where dividend stocks come into the picture. It's actually a pretty simple concept. These are typically solid, established companies that decide to share a slice of their profits directly with their shareholders. And yep, that means you. It's a real, tangible reward for being a part owner of a successful business.
Okay, but how does the money actually get from their profits into your pocket? It's way more straightforward than you might think. Let's walk through the journey of a dividend payment so you can see exactly how a company's success turns into cash you can actually use.
It really breaks down into 4 simple steps. First, the company makes money. Easy enough. Second, the board of directors gets together and says, hey, let's share some of this with our owners. Third, and this is the fun part, that cash just shows up in your brokerage account. And fourth, you get a choice. You can take that cash and spend it, or you can reinvest it to buy even more shares of the company. And that is where the magic of compounding really kicks in, because those new shares are going to generate even more dividends down the road.
So which companies are we talking about here? Well, we've picked out 10 of the most reliable powerhouse dividend payers on the NASDAQ. I want you to think of these as the fundamental building blocks we're going to use to construct our income portfolio.
And to keep things organized, we're going to sort these companies into 3 different categories based on the job they do in our portfolio. Let's start with the giants, the super stable companies that are going to form the unshakable foundation of our whole strategy.
So first up, you've got Apple and Microsoft. Now, Apple is the definition of stability, right? They've increased their dividend for 13 years straight. But you might see that low yield, about 0.4%, and wonder what the deal is. Well, a stock's yield is just its annual dividend divided by its stock price. And because Apple's stock has grown so much, the yield looks small. But that's okay. Its job is stability. Microsoft is in the same boat, a core anchor with 21 years of increases and a dividend that's been growing by about 10% a year. So with these two, the story isn't about high income today, it's about absolute, rock-solid reliability.
All right, now for the fun stuff. Let's talk about the stars of the show when it comes to generating income right now. These are the companies that are going to give our portfolio a major cash flow boost from day one.
And here they are, our income workhorses. I mean, just look at these yields. Comcast, the communications giant, is kicking out a massive 5% yield. Then there's PepsiCo, a total classic with an unbelievable 54-year streak of raising its dividend, yielding almost 4%. And rounding it out is Texas Instruments, a semiconductor leader, giving us a solid 3.4% yield and 22 years of growth. These 3 are the absolute engines of our portfolio's starting income.
Now, for our final group, these are the companies that really round out the portfolio and make it robust. They offer this fantastic mix of a decent starting yield, a great history of growing their dividend, and, this is key, they give us crucial diversification across different parts of the economy.
This last group adds some really important depth. You got Amgen, which gets us into the healthcare sector with a nice yield of almost 3%. Then there's ADP. 51 years of dividend growth. I mean, that's the definition of a sleep well at night stock. We also have Cisco and Qualcomm adding more tech exposure. And then there's Broadcom. Now pay attention here. The current yield looks low, but its dividend growth has been off the charts explosive, which is a fantastic sign for your future income.
Okay, we've met all the players. Now it's time for the really practical part. Let's take these 10 building blocks and actually put together a real, tangible $100,000 portfolio. This is the blueprint in action.
So here's the 30,000-foot view. You can see right away we're being really deliberate here. We're overweighting our high-yield stars. Comcast and PepsiCo make up 30% of the portfolio. That's a conscious choice to really maximize that starting income. The growers make up the core, and then our tech anchors, Apple and Microsoft, provide that all-important stability.
And this is where it all comes to life. You can see exactly how our strategy translates into dollars and cents. By putting $15,000 each into Comcast and PepsiCo, those 2 stocks alone generate over $1,300 of our annual income. At the same time, those smaller positions in Apple and Microsoft are doing their job providing stability, while a growth powerhouse like Broadcom is there for the future potential. See, every single stock in here has a specific job to do.
So, what's the bottom line? We've put all the pieces together.
let's zoom out and look at what this carefully built portfolio actually delivers, both in terms of cold hard cash and long-term potential.
Based on the current numbers, this $100,000 portfolio is expected to generate $2,690 in cash dividends every single year. That's money that gets dropped right into your account for you to use however you want.
So, in investing terms, that gives our entire portfolio a starting yield of almost 2.7%. It's a really nice, balanced result, definitely higher than what you'd get in a savings account, plus you have all the potential for the stocks themselves to grow in value.
But here it is. This is the most powerful idea of the whole thing. That 2.7%, that's just the start. Because all these companies we've picked have long histories of increasing their dividends every year. Your income stream is designed to grow. That means your yield on cost, the return you get on your original investment, just gets better and better over time without you ever having to put in another penny.
So there you have it. We've laid out all the components and the strategy. We've seen how to combine stability, high yield, and powerful growth into a single income-generating machine. The only question left is the one for you. Now that you have the blueprint, what role could a portfolio like this play in your financial future?